Hello class. Today we're going to take a look at reporting cash flows in Chapter 12. Now the purpose statement of cash flows is to inform shareholders and other stakeholders as to the status of the company's cash situation. And this is going to differ than income in terms of what information it conveys. Now it's important because a company needs to determine how it's going to pay its obligations, including debts, and for managers to plan day-to-day operations such as how to make payroll. When we're taking a look at the statement of cash flows, we're going to separate these into three distinguished activities: operating, investing, and financing. Now, operating activities are going to be from the day-to-day operations of the enterprise, such as taking in cash from customers and paying operating expenses. Investing activities are going to be those in which the company goes out and sells some planned assets, or else maybe sells either a long-term or short-term investment of their own, and conversely goes out to purchase planned assets or purchase long-term or short-term investments on their own. This is different than financing activities, where the company may go out and issue its own stock to shareholders or to issue debt for other stakeholders such as bondholders. These would be issuing stock and issuing debt would be cash inflows. Purchasing stock or else paying off some of those short-term and long-term debt obligations would be considered cash outflows in the financing activity. Now let's take a look at how to prepare the statement of cash flows. We're going to break those activities into those three distinguished activities: operating, investing, and financing, and determine what the cash inflows from each of those activities are, or the cash outflows from each of those activities are. And then we're going to sum them to get a net increase or decrease in the cash situation. And this would take us from the prior period end to the current period end. And we're going to list both of those as well. Now, one way to do this is to analyze the cash account. So we have in this T account a beginning balance for cash, an ending balance for cash. We've got cash inflows on the left and cash outflows on the right. Another way to do this would be to analyze the non-cash accounts, so liabilities, equity, and non-cash assets, knowing that the net changes are going to be equal to the change in cash. These are two different methods used for determining cash flows for operations. The examination of the cash account directly is known as the direct method, to where you look for changes in those cash accounts. Looking at the non-cash accounts is known as the indirect method. Either of these methods will get to the same net cash provided by operating activities. Here in this example, $20,000. So let's take a look at how to compute those cash flows using the indirect method. So here we've got an income statement, so $38,000 for net income, and then we've got our changes listed on the right for a balance sheet. So we've got our 2018 information and 2019 information, and then in the bottom left-hand corner we also have some additional information that had occurred in the year 2019. For example, B, purchasing $60,000 in assets, using a notes payable, and another example, E, paying $18,000 in cash to retire certain notes. So if we're applying the indirect method, what we're going to do is start with that $38,000 in income, and then we're going to make adjustments to it. The first set of adjustments that we have here is going to be adding back those activities those accounts that might impact net income but will not impact cash flow. So for example, depreciation expense will lower net income but has no impact on cash either as an inflow or an outflow. So that depreciation expense which was taken out of net income needs to be added back into net income. Similarly, the loss or gain on some of these sales is not going to be directly impacting for cash either as an inflow or an outflow. So the losses will need to be added back in and the gains deducted out. Now when looking at our balance sheet items here, we're going to have those changes and it's going to determine whether or not we subtract or add to net income. If we have an increase in current assets, for example, accounts receivable, that would be representative of additional customers that might have made a sale that would make its way into net income but had not paid cash yet. So they opened their IOU, their tab with us, and then an account we call the accounts receivable. So when that is increasing along with the revenue, we're going to subtract that from net income. So we're not going to include that when we're calculating our cash amount. Similarly, for increases in current liabilities, such as accounts payable, where we're not paying for perhaps supplies yet, or as we take on a liability perhaps, this is going to be money that ordinarily would be paid out, however, is being retained in the company, so it's going to increase that cash. So taking a look at these, we have increases in accounts receivables. Here we're going to subtract $20,000 from that net income amount. Increase in inventory, you see increase in paid expenses, prepaid expenses, decreases in accounts payable, decreases in interest payable, and then increases in income tax payable. We're also going to look at both the investing and financing activities. Here we see an increase in plant assets, 40,000, and then we note from item B, that 60,000 increase in plant assets from a notes payable. We also had a sale of plant assets here, 20,000, that already had accumulated depreciation of 12,000 on it, so an $8,000 carrying value, or net value rather. We sold it for $2,000, representing a $6,000 loss, and then there was depreciation expense as well for $24,000, which had accumulated depreciation as a mentioned credit for $24,000. So if we look at the T accounts, we would see the $60,000 purchase for plant assets, and then the sale had $20,000 for the gross value of that plant asset, so that's going to be represented here as the credit. And then for accumulated depreciation, we had from that sale $12,000 of accumulated depreciation, so it's going to be listed here as a debit on our contra asset, so decreasing that account. And we also took depreciation expense, so that's going to increase that accumulated depreciation for $24,000. We've identified here $2,000 as the cash inflow from that investing activity, and the $60,000 purchase of that plant asset was done using a notes payable, so it's a non-cash investing or financing activity. So looking at the financing activity, here we see our long-term notes payable going from $64,000 to $90,000, so a $26,000 increase here. Looking at that note E that we saw, where we had paid $18,000 to retire that note payable, we're going to be reflecting it in the notes payable, retiring it at $34,000 is going to be our debit here. We also issued $60,000 in those notes when purchasing the $60,000 plant assets, so that's going to be listed as a credit here, increasing that amount. So we're going to have cash flows from financing activities for paying that retired note. The amount that we used, $18,000, and that's going to be listed here. So we also had a stock transaction where $15,000 was raised from the market, 3,000 shares, $5 per share, increasing from $80,000 to $95,000. So that's going to be representing a cash inflow from financing activities of $15,000. And then here we had a cash dividend of $14,000. So that's going to be decreasing to retained earnings. So we're going to list it here as a debit for retained earnings. And also it's going to be a credit to cash. So we'll have a cash outflow of $14,000 for financing activities here. So if we look at that statement of cash flows, we see that our cash balance from the prior year, $12,000, current year $17,000, that increase in $5,000. But the statement of cash flows lets us look at each of those activities individually as well. So we can see that that $5,000 increase in net cash is contributed $20,000 from operating activities, $2,000 from the sale of the plant assets, so $2,000 from investing activities, and that financing activities contributed a $17,000 cash outflow. both from paying the retired notes and then paying the dividend. Some of that was absorbed from issuing stock, but had a $17,000 net cash outflow from the financing activities. The net of these three activities, 20,000 plus 2,000 is 22,000, minus 17,000 is going to be 5,000. So that's our net increase in cash. So taking a look at one of our ratios here, the cash flow on total assets. We would use that formula by taking our operating cash flows, that 20,000 from the previous example, and then dividing it by average total assets. And again, we're using average total assets because instead of just using one snapshot of time, we want to use the prior year amount, current year amount, and averaging it to try to match that time period here. And this is going to conclude the lecture on Chapter 12.